Well, hi, everybody. We're actually going to do something you've all asked us to do. You're going to go back to class today. We're going to talk about investing using history. So fortunately for me, I have my compadre with me, Stephanie Larson. She's had to learn the hard way too. I'm a I always say I'm a historian who manages money. So we're going to talk about it. So I want you all to go pull out your copy of Investment Atlas. Okay, there it is. I know you have it on your coffee tables. You've all promised me you've done it. But look, the reason we're being joking here, but we want you to remember we're serious when we say we put history to work. We do, and I'm tired, and I know we hear it all the time. Oh, it's different this time. It's special this time, or people think that we're like the fall of the Roman Empire and we're about ready to go off a cliff, folks. We're going to have a talk today. I want to dispel those myths. I want to take it from there. Now, look. I guess now I'm considered an elder statesman, Steph. I guess am I? I
didn't mean I want to say.
You're making me feel old, but
you are.
Yeah, one of our associates reminded me I'm coming up on 50 years in this business. So
wow.
yeah, thanks, appreciate that. All right, but here's the good thing. I've seen history. I've seen
Correct.
it. I've gone through it. So let's first talk about this. Are there things that are different? So let's talk a bit about technology.
Yeah.
Okay, now let me throw my 2 cents in and you tell me.
I'm just going to say, first off, I don't believe in black swans. I really don't.
No.
I really don't. It's happened maybe it doesn't repeat, but it rhymes, right? That's my stance.
Well, I agree with that. And I also will say this. When I hear somebody talk about a black swan, they're not going back far enough to find it, okay? Now, let's talk about AI for a moment. AI is going to put all money managers out of business and, everybody in Wall Street's... Folks, I heard the same, excuse my French, crap back in 87 about computerized trading back then. I heard it about all this crap in the dot-com bubble about how we're just going to have computers do everything. No, look, we've always had technology on Wall Street. In fact, finance usually adopts technology, maybe outside of the military, but finance is always looking for an edge. Look, there was a period of time, for those of you who are old enough, go ask if your grandparents are alive about ticker tape machines. That was a marvel of technology, being able to get electronic trades. The computerization. I was around when computers were big floppy disks going into a box, a Tandy computer. I remember all that. But the point is, it does make things faster.
Sure.
I mean, we have this going on. AI is another generation of it. But Stephanie, what do you think? Are you worried about your job being replaced by a computer?
No, I don't. For me personally, I actually think what AI is really going to do is it's going to make the computation of the analytics faster.
Yeah,
I do. I think we might not have the same analysts like we did when I came through this, the Wall Street.
Our old jobs are obsolete. They're all gone.
I don't think I would have an analyst job, but then how do you become a portfolio manager if you've never been an analyst? You still have to understand what it means and I think it's just going to make the data consumption faster and the analytics much more robust. But you have to have someone that still has to read it, has to know to do with it. We have models that have been managing money for decades. I've built one of those models back in 2006. Okay, the model, it was a Monte Carlo system model. It did all of the computations and analytics that I wanted. It would forecast the return and standard deviation and the volatility. And I used that as my guide for where I wanted to invest, right? But that's 2 decades ago, and nothing's changed.
Well, I'll add another part to it too. I mean, obviously, we do proprietary research 100%. All the time. We've actually built indices. I mean, that's one reason you thought it was great to work with me is that, hey, we do the raw research. Here's my problem, is that when I look at it, I've heard it firsthand. I've seen it firsthand. AI, great. It's wonderful, except one problem. If the data is bad, it's going to come up with bad conclusions.
Correct.
And I think that my concern is right now that there's such a rush to get this into the markets. They're not taking the data back far enough. Hey, I know for a fact, Investment Atlas, go in the back of your book, folks. There's tables back there that have housing prices, stock prices, commodity prices since 1865. I will guarantee you there's a whole bunch of AI models out there that a lot of these new popular companies are using. Their data doesn't go back that far. I believe this to be true. Hey, look, AI to me is like a wonderful combustion engine Ferrari because I think the EV Ferrari looks terrible. Okay.
I will say the one area that I've heard it in use that actually does freak me out a little bit. So we had some younger clients that have come on board that they've been kind of managing the money themselves, and they were working with essentially like a Robinhood. It wasn't Robinhood, so please don't sue me on that one. But a company like a Robinhood, where they had an AI model that would generate what the investments were, and they would just deposit the money. It would automatically invest the money into that, and that was it. And I asked a lot of questions to the clients about like how performance was. It was average. It was okay. But like you and I both know from experience that when markets turn, and they will on a dime, it's not even the dot-com bubble or 2008 or 2020 COVID, these flash crashes, 2022 with the interest rate hikes. Someone has to drive that ship. You can't just put it on autopilot. We raise cash, we hedge the portfolios, we make adjustments on the fly. I don't know if that software can do that, or the AI, whatever happens to be how it's managing it. Like, who makes sure that it's doing what it's supposed to do? Who's testing its performance? Who knows if it's any good? And people are just depositing money into it, and they're giving it a go, and that terrifies me.
Yeah, I totally agree.
Yeah.
I would add to it too that I think that AI was built by a human brain. It was programmed by a human brain. That means there's biases.
Correct.
We all have them. I have them. You have them. We all do. This industry has had, for a good part of my career, what I call a long bias.
Correct.
It is great about, hey, just buy the dip, and watch it keep going up. Well, guess what? Many of you have been around with me when they don't recover. That you go, the dot-com bubble was a 2.5-year bear market. There are times to sell the rallies. And I don't think AI is equipped for that yet. Maybe down the road it will be, but I haven't seen it. So
well, and actually, let me give you this anecdote as well. I actually don't think you know this story about me. So I worked for some of the largest firms on Wall Street, right? You know that. One in particular that I was working for, I was what we call a SME in the industry, a subject matter expert. And I would work with, there was an entire IT floor, okay? And the IT floor had all these coders. I actually can code in SQL and in R. It's a skill that I've learned over the years of working in the industry. And they had all these models and things that they use to manage the accounting, the reporting, and things like that. And I know for a fact that those IT guys had to check it every single day. These are some of the best coders I've ever known. And they had to maintain it every single day. Yeah. I just don't see how that's being done with AI. Like, an entire floor, 50 people that maintained that entire company to make sure it ran correctly.
Yeah. No,
I don't know.
Well, I was a junior analyst. My job was to filter data.
Yeah.
And those jobs are gone.
Yeah.
It's kind of like with media. We used to have fact checkers. That's all gone. That's all gone now. It's long gone. You can say pretty much anything you want, and no one's going to catch you.
Yeah.
And if they do, go talk to my attorney. That's kind of the attitude.
Yeah.
So the other thing historically, so technology, folks, it's been around. Hey, there it is, ticker tape machine. That was the marvel of technology. Thank you, Thomas Edison.
Don't you have one?
I do have a tape. Yeah. Actually, I remember having to read the tape. Okay, other thing. As you know, we do commodities. Okay, I think that there was a period of time when at a brokerage house, you had commodity brokers. In fact, the reason I ended up at Merrill Lynch was because I had a 3 coming off trading at the commodity pits in Chicago. I'm a little concerned that we have people telling you, oh, it's different today. We have these alts. I love this magic term, alts. Folks, I know many of you, alt, there was crypto. It was an alt. Hey, I went and did my certified cryptocurrency trading. Hey, guess what? We had private currencies back in the early 1800s. Again, there's nothing new here. These are reiterations. My only concern is just because it's new doesn't mean it's better.
True.
And would you agree with me on that?
Correct.
Okay, I think, again, this idea that you got to jump into this here or there. And look, I get a lot of flack because I'm not a big fan of foreign investing. Same thing. There are times clearly you can make money trading these markets, but you know what? I said earlier this year, if you're in foreign markets, you're going to want to think about getting out. Guess what? I was right. They've gotten slaughtered this year. China's down 15% on the year.
Correct.
So I think, again, what are your thoughts on this new?
I think people get fascinated with the new stuff. They find it interesting. They like to see what the new technology comes out. I'm based just out of north of San Francisco, right? So we have huge tech symposiums. Silicon Valley is right down the street from me. So for me, I've always been exposed to it because of just geographic location. And I think it's interesting. I mean, I think I've had every iPhone that's ever come out, which I hate to admit that, but it's true. But no, just newer doesn't necessarily mean better. I mean, I do think there are some improvements and some things that I like over the time, but no, not newer's not always better.
Yeah. I would just say this also on new. New, at least the Wall Street likes to repackage stuff and sell
Definitely.
it and put a big fee on this new thing. So again, look, I mean, there's a lot of folks out there, look, especially those of you who might be in the wealth management area, financial planning area. Look, we understand. We sub-advise for other managers. So you have a bell-shaped curve. There's the core asset area. You're then out in the tails, these unusual areas. I understand that people are trying to differentiate themselves.
Sure.
But I don't necessarily think, like right now, private equity, this big thing, PE as we're calling it, or private debt. Again, folks, it's been around for a very long time. Real estate investing is private by its nature. So again, I just get concerned that people think they're missing out, and it's not meant for everybody.
It's not meant for everybody, but I was in the industry in 2008. I remember what happened back then.
With mortgages.
With mortgages. I remember the CIO that I was working for at that time. We had CDOs and CLOs on our books, and we couldn't price it. We had no idea what the price was. We had to work with a third-party independent company to price everything because we had to, by law, report every quarter the performance to our clients. We had no idea. So a lot of times it's all new, fun, and shiny until something happens, and then you have to solve it and fix it. And I mean, that's actually, one of my things against IPOs, which we were discussing a while ago. I don't like IPOs because you've never seen the performance of that company through different cycles. You can't stress test it against 2008 or the dot-com bubble and see what the major drawdowns are going to actually look like.
Totally.
So it's the same thing with the new stuff that people, you're right, Wall Street, they don't create a lot of new things. They just repackage it and then they sell it as something new.
Yeah.
That's common.
New and improved.
Yeah.
Yeah. It's always new and improved. And then you find it's got the same old problems that it
And
had
just costs
before.
more.
And the sad part is now I'm an old guy. Problem is I'm old enough to remember what was happening before. And again, folks, I'm not trying to be cynical here. I'm not saying, hey, ask us. I mean, we get asked all the time. But just because something's new and improved, same with new stocks versus old stocks. I mean, we have a legacy stock index. Why did I build it? Because I think there's value in looking at companies that have been around through all the economic cycles. And I think there's value in monitoring that and looking at what's really going on with the markets. I would also say, things that, so let's switch gears here real quick.
Okay.
What are the things historically that people keep missing the mark on? What would you?
Oh, that's a great question. I mean,
politics.
okay, sure.
I think that, and look, because we have clients from all walks of life.
100%.
We're almost a bell-shaped curve.
Internally and in our company, we are. Internally in our company,
we absolutely are.
Yeah.
I'm concerned that people, that they, instead of paying attention to history, hey, by the way, Atlas, again, I keep going back to it. If you don't have a copy of it, we'll send you one, folks. But here's the deal. Go back and look. There have been bull markets and bear markets with both parties.
100%.
Okay? Now, I just wrote an article about, many people might be shocked to hear this, but in stocks, Ronald Reagan and Obama were almost even.
Correct.
Okay? Bill Clinton, we had the best market ever. And Trump was he's right in there, right in the mix now at number 2. So again, my point is, don't politicize your portfolios. History does not support this.
Correct.
Let us do our jobs. Now, look, I'm not saying there's not shifts in stocks. Alternative energies. ESG is not popular right now because you have administrations that do it. But my point is, don't politicize. Would you agree? Just don't politicize.
100% agree. And I actually was just having a conversation with a client yesterday about it because he's scared about the treasury market. And he thinks that the bond market's going to explode. And I was like, well, there's bond markets, plural. There's the muni market, the treasury market, the corporate market. And if you can't be in bonds, which I would say is one of the least risky areas of the investment space that you can be next to treasuries, right? If you can't be in stocks, you can't be in the bonds, in treasuries pay 3%, right? And what are you going to do with the money? Your money is going to lose value towards inflation. So at some point, you just have to rationalize your fears, right? And I'll hear it from both clients. clients on the left, they think that the market's going to blow up and the portfolios are going to disappear. And then clients on the right just think that if they don't stay in power, that their portfolios are going to blow up and the markets. I mean, everyone has the same exact irrational fear, and you have to rationalize your fears at some point.
Yeah. Absolutely. I think another big one I'm going to bring up right now, and look, we'll gladly go head to head with anybody who's these buy and hold, always hold it people. I can historically prove that we have bad bear markets over 20% of the time.
Correct.
And I'm sorry, folks, for you to be taking advice from somebody out there who is telling you invest for the long term, don't sell. And look, taxes are a problem. I mean, I did a whole article in Forbes about, people live in some place with high state income tax, others don't. Maybe that has an effect, but you should realize that historically, markets will, at some point in time, go down severely. And I think, again, to not learn that lesson over and over and over again, look, God bless John Bogle. He came up with the buy and hold theory. And guess what? He did it in the middle of the 1980s when the market literally went straight up, or in the 90s. And I remember, touting that all the way through it. And then here comes 2000. So if you were to take, I want you to think about this century, okay? From 1990 on to now, folks, we had a 2.5-year bear market.
Correct.
The dot-com bubble. We had my indicators all heck broke loose, November, December of 2007 to March of 2009. For those of you who remember it, 50% correction. Okay.
So painful.
Yeah, it was very painful. Yeah. Okay. Then we had COVID. Now that was a flash crash. And thank God it came back, but there was some damage done because people sold at the bottom. Then we had 2022, where you had the interest rates went up. Or was it 23? But it was 22. Yeah. Again, market went down 22%. I'm just simply suggesting history does not support buy and hold. Now, would you agree with me?
I think active management is a thing. I know passive money management was very popular for a long time. The dawn of ETFs, where people were like, well, why do I have to pay you to manage the money? I'll just buy that and have great exposure to the market. It'll go up. It was fun until it goes down, And I think that, I would agree. I think my biggest concern that I have with clients or people that I'm hearing from is they can't stomach a 5% correction.
Yeah. Oh yeah.
Oh, it's down 5%. Everything on fire. It's not. It's 5%. A stock market that goes up and does not pull back is actually incredibly unhealthy. You need to have at least some pullbacks in it. Otherwise, it's just completely overheated, completely overbought.
Or sector rotation, where you do have some sectors that blow up.
Yes.
We've seen that happen. No, again, this is just historical lessons. Yes. And I don't know. And sadly, I think it is human nature to not learn. I hate to say it. I've written 5 books now. I mean, how many times have we had talks about that? And I just say, look, go to page 39. I've written about it for 15, 20 years. Stephanie, I would also say this, and it troubles me because obviously we both have done work at the academic level.
Correct.
Obviously, I'm very involved with UNLV. Actually, we crossed paths at St. Mary's when I was.
Did?
I mean, many of you might not know this. I taught at the graduate level. I corrupted the youth many, many years ago.
And I went to St. Mary's, so God is a Gale.
Yeah, so there we go. But here's the problem: is that, and I want you all to think about this. You're told if you diversify, you're fine. There's no danger. You're perfectly fine. Yeah. It's been, excuse the pun, bastardized. It's been misused by our industry.
Correct.
And the problem, I'm going to bring up a classic point of this. We have more ETFs now than we have individual stocks.
Correct.
And I think that I wrote an article in Forbes about the next triggers, the next boomerangs that could hit this market. I think that there is this comfort that they think they're diversified in 30 ETFs, and those 30 ETFs all own a lot of the most expensive stocks. I think that's a recipe for disaster. And so my point is that, the Winans portfolios, we buy stocks. We know exactly how much exposure we have. It's risk management. But folks, I guess what I'm trying to say is, if you could go back and talk to your grandparents or anybody who was back in the 1970s, there was over a decade where the markets didn't go up. You had to actively manage and not buy a bunch of stuff and hope it goes up. I think we could see that world going forward, where you might find that those new, although we're having a great time right now.
Sure.
But, as bull markets age, they get more volatile.
Correct.
Yeah. So I think that we should all get used to those 5% hiccups. Stephanie, any other tidbits of wisdom of your career? Come on now, you're veterans now.
I have wisdom.
Yeah, well, but besides being a smartass, yes. Okay.
Well, it's part of my charm. Tidbit of wisdom. For me, I think the most successful investors are the ones that have a process, something that they've tested, that they have statistics behind, and they stick to the process. If you have a money manager or a financial advisor that changes things on the regular, on a whim, and they're trying, to me, that feels like they're just throwing things against the wall and they're seeing what sticks. I think you just need to, have a process that that works and really stick to it and have belief in it.
Yeah, I would agree with that. Yeah. I'll add two other things. Yeah. Bigger is not better.
Correct.
In fact, I love it when, you hear about the greatest advisors in our industry. Guess what? Go look at those periodicals. There's no track record. It's how much money they've raised. It is client money. That's fine, but the bigger managers actually have some disadvantages that now we're a medium-sized manager. Yeah. Our goal is to get up to $1 billion and know our clients on a first name basis. But the point is, bigger means there's a lot of things that we can do that they cannot do. So I don't agree with that idea that bigger is better. And number two, folks, I'm going to finish on this note. All investing, I don't care how far back you go read it here. You either own or you loan. It's that simple. You own something. You own a building, you own a house, you own stock. Stock is ownership in a company, or you're lending money to a company, the U.S. government, a municipality, whether it might be a school district or a state. That's it. It's loaning. Somehow, some way, our industry flipped these two around and told you that it's better to buy and hold owning and to trade loaning. You know what? Let me tell you what I mean by that. When you own a bond, it's like your mortgage, okay? There comes a date when it's due and you know exactly how much is going to be paid during the interest payment periods.
Correct.
It's a legal obligation. They have to do it or they have to go bankrupt, okay? The Treasury has to do it, the municipality, and so do companies.
Correct.
Okay, you're telling me that it makes sense to trade this, and which is what a lot of mutual funds do. They trade this stuff. And you don't believe me, go look at the turnover ratio of a lot of the nation's largest popular bond funds. But then you're told to buy and hold a stock, and we just told you over 20% of the time, you're going to have a hit. I guess, Steph, when did our industry get this screwed up? This is such a monumental mess up. I don't even know where to go with it.
One of the things when it comes to the loaning part, so that's fixed income, that's bonds, right? Is you have what we call safety and surety. The safety of that it tends to be a lot less volatile, less risky. Even in 2008, the default rate was sub 5%. In the middle of the worst credit crisis we've ever had, default rates on bonds, corporate bonds, were still less than 5%.
Yeah.
Right? So you get safety and surety. You know what you own, what you get paid, when it gets paid back. You should always hold that. Our bond strategies, we buy and hold. Our stocks, you should trade actively. Not like day trading, but you don't just ride it all the way down just because it had done well before. It did well before. It doesn't mean it's doing well now. I don't know when it changed, but sometime in the last 2 decades, I think that mentality really flipped and people were just like, no, buy and hold. If you buy and hold, your portfolio will double every, 10 years or something like that?
Well, yeah, rule of 7.
Yeah, rule of 7.
If you're at 7%, you'll double every 10 years.
Yeah.
I'll add to this, and I'm not cynical by my nature,
okay,
but I do think that people have amnesia. They forget very quickly. I learned a long time ago, learn from your mistakes.
Correct.
Now, whether I'm an athlete, in the military,
sure,
in professional, you learn from your mistakes. And somehow, some way, investors, because we, being an American investor, hey, we're in one of the best markets in the world.
100%.
You have liquidity, you have laws that protect you, you're insured bank accounts, you have all of it here. You don't, if you're a wealthy individual in Canada or Mexico, 2 of our neighbors, you don't necessarily have the same protections. The Canadian stock market's tiny.
Yes,
you're in
true.
Energy. That's pretty much it.
Correct.
So here, the diversity of what you can go into. But I somehow think that it's made us fall back on our heels. It's made us, I will dare say, lazy. And people just go on the assumption that it's gonna recover. And,
Yeah.
and I think, again, we talk about whether it's AI or any of these things. Again, we'll finish on that note. Learn from history. It doesn't always, folks, it has a way of cycling.
It does.
I'm sorry, if you think you're smarter than your grandparents, first off, if they were here right now, they smack you in the head. They're not. They actually had to be smart with money.
Yeah.
Because many times they went through the Depression. They know when
100%.
something go wrong. But listen, this is not to be condescending, but it's to be real, okay? And it's important as you as investors, you need to monitor what's being told. And if things sound too good to be true, they probably are.
Yeah.
There's nothing out there that's for free. I love when people say, oh, they're offering this for free. Nothing's for free,
There's no free
okay?
lunch.
This is one of the highest paid industries in the world. They're not doing things for free. I would also say, too, as somebody who has gone through many years in this business, do be aware, like insurance products, annuities and all these kind of things. Again, be careful when you're being sold things.
Yeah.
Go look at the cost structures. Again, there's just nothing for free. There's just nothing out there that is absolutely foolproof. Stephanie, we're going to do more of these little ABCs of investing. So listen, if you're interested, two audiences out there. If you are a financial professional and you'd like to talk to us about how we can help you with your clients, we're very good at it. We're loyal. We'll work with you. We'd be happy to. If you're an individual and what we've said to you is something truly different, give us a call. I think you'll find that, look, my name's on the letterhead. I take great pride in that, but I also take great responsibility with that. We are different. We are independent. We're independent thinkers. So again, and any of you out there who think we're wrong, hey, bring it on. Be glad to go look at our Morningstar rankings. And as they say in poker, read it or weep. But anyway, folks, I hope you learned a thing or two. You can find our books on Amazon and our articles on Forbes. And if you're a podcast fan, go turn into Winning with Winans. You'll enjoy it. Anyway, Steph, thank you for joining us.
Always. Pleasure.
Okay, folks, good luck with everything. Take care now. Bye-bye.